There is a pattern in economic history that repeats with mechanical precision. It doesn't happen every decade, and it doesn't happen randomly. It happens only when specific conditions align perfectly. We see extreme asset valuations, record debt levels, excessive leverage, and a widespread, almost religious belief that this time is different. And then, a trigger event forces a liquidation that wipes out trillions. These conditions existed in 1929, before the Great Depression. They existed in 2008, before the Great Financial Crisis. And right now, in January 2025, every single one of these conditions exists again. Not similar conditions, identical conditions. The stage is set, the players are positioned. And if history is any guide, the crash is scheduled for late 2026 or early 2027. This isn't prophecy. This isn't doom-mongering. This is simple pattern recognition. To understand where we are going, we have to look at where we are right now. We are currently living inside the largest everything bubble in human history. Usually, you have a stock bubble, like 2000, or a housing bubble, like 2008. Today, we have both. The median home price in America is $420,000, while the median income is just $75,000. That is a price-to-income ratio of 5.6 to 1. For context, in 2006, right before the housing market collapsed, that ratio peaked at 5.0. Housing is now more overvalued than it was during the subprime crisis. But it's not just homes. Corporate debt has hit $13.5 trillion, which is 72% of GDP. Government debt is $36 trillion, or 120% of GDP. Total debt in the U.S. economy, when you add up government, corporate, and household, exceeds $90 trillion. That is 320% of GDP. Every single sector of the economy is leveraged beyond its historical limit simultaneously. Everyone is expensive, everyone is in debt, and everyone believes prices will keep rising forever. Why? Because for 15 years, the Federal Reserve taught investors a simple rule: buy the dip. They printed $8 trillion to save the market every time it wobbled. But this time, the Fed has a problem that it didn't have in 2008 or 2020. They are out of ammo. To understand why the 2026 crash will be worse than anything we have seen before, you have to understand the trap the Federal Reserve has built for itself. Since 2008, investors have been conditioned like Pavlov's dogs to believe one simple truth: the Fed will save us. Every time the market dropped, the Fed cut interest rates or printed trillions of dollars. This created a phenomenon called moral hazard. Nobody fears risk anymore because they believe risk has been illegalized by the central bank. But here's the problem that nobody on Wall Street wants to talk about. The Fed has already fired all its bullets. For a decade, interest rates were at zero. You can't go lower than zero without destroying the banking system. Their balance sheet expanded from $800 billion in 2008 to nearly $9 trillion in 2022. They used every ounce of their power to fight the last crisis, leaving them with nothing in reserve for the next one. And when they finally tried to normalize things by raising rates from 0% to 5.5% to fight inflation, they triggered a ticking time bomb in the debt market. This is the refinancing wall. Trillions of dollars in corporate debt and commercial mortgages were issued when rates were at rock bottom, around 3%. That debt is now maturing, and it has to be refinanced at 7% or 8%. This is a mathematical death sentence for zombie companies that barely survived on cheap money. The Fed is now caught in a catch-22 nightmare. If they keep rates high, the debt burden crushes the economy and triggers a depression. But if they cut rates aggressively to save the economy, inflation will roar back to life, destroying the dollar. They are trapped. In 2008, they had room to cut rates. In 2025, they are cornered. This is the part of the story that the elites don't want you to understand. They want you to believe they have a magic wand. I have actually prepared a deep dive video, a killer video, that exposes the specific mechanisms the elites use to manipulate markets during these exact moments. I am honestly afraid to upload it because it is the kind of content that gets channels shadow banned. But I will make a deal with you. We are racing to hit 1,000 subscribers by December 31st, 2025. If we hit that number, I will take the risk and release that video for all the insiders. So if you want to see how the game is really rigged, hit that subscribe button right now. Now let's look at the specific triggers that are about to topple this house of cards. So we have the bubble and we have the trap. But what is the specific spark that lights the fuse? In 2008, it was subprime mortgages. In 2026, the math points directly to one sector: commercial real estate, CRE. This is the most likely trigger because the collapse is already underway, happening in slow motion right in front of our eyes. Office buildings across America are currently sitting 40% to 50% vacant because the shift to remote work is permanent. Companies that used to lease 5 floors now only need 2. But the real problem isn't the empty desks, it's the empty vaults. These skyscrapers were bought with mortgages at 3% interest rates. Over $2 trillion of these loans are maturing between 2025 and 2027. The owners have to refinance, but now the rate is 7% or 8%. Do the math. A building that was barely profitable at 3% is mathematically bankrupt at 7%. We are already seeing giants like Brookfield Asset Management, one of the largest real estate owners on earth, simply stop paying the mortgage on massive office towers in Los Angeles. They are handing the keys back to the bank because the building is worth less than the loan. It is economically rational to default. And here's where the contagion starts. Who holds these toxic loans? It isn't the big, too-big-to-fail banks like JP Morgan. It is the regional banks. Small and mid-sized banks hold nearly 40% of their loan books in commercial real estate. When those loans default, the banks take losses that eat through their capital reserves. We saw a preview of this in 2023 with Silicon Valley Bank and First Republic. That was just a tremor. The earthquake comes when hundreds of regional banks fail simultaneously because their collateral is worthless. Whether it's this real estate collapse, a major corporate bankruptcy, or a geopolitical shock like a war over Taiwan, the trigger doesn't actually matter. Once the first domino falls, the mechanics of the crash take over. And those mechanics are brutal, predictable, and unstoppable. Once the trigger event happens, whether it's a bank failure or a debt default, the crash begins. But it doesn't happen all at once. Based on the patterns of 1929 and 2008, it always unfolds in a predictable 5-phase sequence. The timeline might compress or extend based on algorithmic trading speed, but the sequence is locked. Phase 1 is the initial shock. The trigger happens and the market falls 10% to 15% in a matter of days. In 1929, this was Black Thursday. In 2008, it was the collapse of Bear Stearns in March. Investors are surprised, but they aren't panicked. The media will roll out experts who say, the fundamentals are strong, this is a healthy correction, buy the dip. The Federal Reserve will issue a statement saying they are monitoring the situation and stand ready to provide liquidity. Millions of retail investors will listen and pour their savings into the market, thinking they are getting stocks on sale. They are walking into a trap. Because then comes phase 2, the false recovery. This is the most dangerous phase because it convinces everyone that the crisis is over. After the initial shock, the market stabilizes and even rallies for weeks or months. In 1929, stocks nearly recovered to their pre-crash highs by November. In 2008, the market rallied all summer, and analysts declared the financial crisis contained. In 2026, this false recovery will likely last 3 to 6 months. The initial event will be blamed on specific mismanagement. It was just one bad bank, they'll say. The Fed might even cut rates modestly to boost confidence. Investors who bought the dip feel like geniuses. But beneath the surface, the structural rot, the bad debt, the leverage, is spreading like cancer. The false recovery is just the calm before the hurricane. And when it ends, the real crash, the cascade, begins. When the false recovery ends, we enter phase 3, the cascade. This is the moment the floor falls out. In 1929, it started on November 11th. In 2008, it was the week Lehman Brothers failed. In 2026, it will likely happen when a major credit freeze forces the algorithms to sell. The cascade is not an emotional event. It is a mechanical one. It is triggered by a liquidity doom loop that has three distinct stages, and once it begins, no amount of positive thinking can stop it. Stage 1 is the margin call. Remember all that debt we talked about? When asset prices fall just 20%, the investors who borrowed money to buy stocks or real estate get a phone call from their bank. Pay us back, or we sell your assets. Most people don't have the cash, so the bank automatically sells their positions. This forced selling drives prices down further, which triggers more margin calls for the next group of investors, which triggers more selling. It is a self-feeding fire. In 1929, this process took days because it was done by humans on telephones. Today, it happens in microseconds. Stage 2 is the algorithmic acceleration. This is the new variable that makes 2026 so dangerous. 80% of daily stock volume is now controlled by machines. These algorithms are programmed with stop-loss rules. When the market hits a specific downside target, they don't ask questions, they sell. We saw a preview of this in the flash crash of 2010. But imagine that speed applied to a global credit event. The machines will bidwack the market into oblivion before a human trader can even spill their coffee. Stage 3 is the credit freeze. This is the final nail in the coffin. When banks see assets collapsing, they stop lending to everyone. Even healthy businesses can't get loans to pay their employees. The gears of the economy grind to a halt. This is the moment the stock market crash becomes a glorious depression. The Federal Reserve will try to step in, but history suggests they will be too slow. This leads us to the ultimate question, and I want you to go on the record. The media keeps telling us that Jerome Powell and the Fed have learned from their mistakes. So, do you trust the Federal Reserve to engineer a soft landing this time? Or are we mathematically locked into a hard crash? Go to the comments section right now and type just one word: soft or hard. I want to see if the sentiment of the people matches the narrative of the news. Because while the majority is arguing about the landing, the smart money is already preparing for the impact. They know that while the middle class gets wiped out, a specific group of investors is about to make a fortune from the wreckage. Here is the brutal truth that they won't teach you in school. A market crash does not actually destroy wealth. The money doesn't just evaporate into thin air. It simply changes hands. It moves from the weak hands, the leveraged, the unprepared, the middle class, to the strong hands, the liquid, the patient, the elite. This process is called the Great Wealth Transfer, and it happens every single time the cycle resets. In 1929, the families that ruled America for the next century, the Kennedys, the Rockefellers, didn't panic. They held cash. When the market collapsed 89%, they stepped in and bought America's greatest companies for pennies on the dollar. In 2008, Warren Buffett didn't run for the hills. He used his cash pile to buy Goldman Sachs and Bank of America at crisis prices, making billions when the dust settled. So, who gets destroyed in 2026? It will be the middle class holding traditional, safe assets. Families with 401ks full of index funds will watch 50% of their retirement vanish in 6 months. Homeowners who bought at the 2024 peak will find themselves underwater, owing more on their mortgage than the house is worth, trapping them in properties they can't sell. Small business owners will face a credit freeze where their lines of credit are cut overnight, forcing them to close their doors. This is the tragedy of the cycle. The people who played by the rules get punished the hardest. But who profits? The vultures who are preparing right now. First, the cash holders, the investors who sold early and are sitting in treasury bills. When the market crashes, cash is king. It gains purchasing power. You can buy real estate at a 40% discount. You can buy blue chip stocks with 8% dividend yields. Second, the short sellers, the hedge funds betting against commercial real estate and regional banks. Just like Michael Burry in The Big Short, they will make fortunes while the world burns. Third, the gold holders. When the Fed eventually panics and prints $10 trillion to save the system, Phase 5, the dollar will devalue, and gold will rocket to $5,000 or higher. I bet you have a friend who tells you that cash is trash and that you should be fully invested at all times. Do them a favor. Share this specific timestamp with them right now. They need to understand that holding cash isn't losing to inflation. It is buying an option to purchase the world on sale later. The wealth transfer is coming whether you like it or not. You can either be the one transferring the wealth or the one receiving it. And the difference comes down to timing. This brings us to the final piece of the puzzle. When exactly does the clock strike midnight? So, when does the clock finally strike midnight? Based on the overlay of 1929 and 2008, the timeline is terrifyingly clear. Early 2025 is the euphoria phase. This is where we are now. Markets at records, belief in the soft landing, and maximum leverage. Late 2025 is the trigger phase. We will likely see the first major bank failure or corporate default. 2026 is the cascade. The false recovery fails, the credit markets freeze, and the asset prices begin their 50% decline. By 2027, we hit the panic bottom, where the Fed finally panics and prints the next ocean of money to restart the cycle.
We're losing ground, sell everything.
This timeline could shift by a few months, but the sequence is locked in by the mathematics of debt. You cannot borrow 320% of GDP and simply grow your way out of it. You have to liquidate it. The system is looking for a reset button. The only question is whether that reset wipes you out or whether it becomes the opportunity of your lifetime. History is clear. Those who understand the pattern profit. Those who ignore it lose everything. This brings us back to our mission. This channel exists to give you the playbook that the mainstream media is afraid to publish. We are building a community of insiders who refuse to be collateral damage. And we have a goal. We are racing to hit 1,000 subscribers by December 31st, 2025. If we hit that number, I am going to release the killer video. This is the script I have already written that exposes the specific illegal mechanisms the elites use to front-run these crashes. I am genuinely afraid to upload it because it attacks the people who own the platforms. But if we hit 1,000 insiders, I will take the risk. So, you have a choice. You can go back to sleep and hope the Federal Reserve saves you. Or you can click that subscribe button, join the insiders, and learn how to survive the crash. The pattern is repeating. The setup is complete. The only thing missing is you getting prepared. Don't let history catch you sleeping. I know watching a video like this can feel heavy. I know that seeing the timelines and the debt clocks can make you feel small or anxious or even hopeless. I feel it too. It is hard to sleep when you know the math doesn't add up. It is hard to go to work and pretend everything is normal when you know the system is flashing red. But I want to tell you something important. The fact that you are still watching this video, the fact that you made it to the very end, tells me everything I need to know about you. It tells me you are not one of the sheep. It tells me that you have a gut feeling that the world is changing, and you are brave enough to look for the truth. Most people clicked away 10 minutes ago. They went back to the distractions. They went back to sleep. But you are still here. That means you are exactly the kind of person who survives these shifts. Anxiety isn't a weakness, it's a signal. It's your brain telling you to prepare. And you don't have to do it alone. That is why I started this channel. I am not going anywhere. I am going to be here every week, tracking every data point, watching every move the Fed makes, and decoding it for you in real time. We are going to navigate this minefield together. And that brings me back to that killer video I mentioned. I'm serious about that. The script is sitting on my hard drive right now. It exposes things about the market structure that make this crash look like a tea party. I want to give it to you, but we need to build this stronghold first. So, if you trust me to lead you through the storm, help me hit that 1,000 subscriber goal. Not for the algorithm, but so we can build a community that the elites can't ignore. We are going to make it through 2026. And we aren't just going to survive it, we are going to own it. So, you have a choice. You can go back to sleep, or you can click that subscribe button, join the insiders, and get ready for the fight of our lives. Don't let history catch you sleeping.